Hey everybody, welcome to the morning market briefing. It is Tuesday, March 15th, 2021. Hope everybody is doing well. Hope you had a good day yesterday. Let's jump in today. We're going to talk a good bit about just kind of the state of the market as we have a decent amount of data from the Merrill Fund Manager that we like to look at. Ben, take us on a little bit of a tour in terms of what we're seeing thematically. I mean, I don't think people will be terribly surprised that relatively pessimistic and bearish positioning is what the theme has been within portfolios, which is both supportive of and supported by what we've seen in publicly traded equities, as well as even in fixed income to an extent. But talk us through kind of at a high level what we're looking at.
Yeah, I think there are three major themes. One is what the fund managers see in terms of the economy. Number two is what their sentiment is on the markets. Number three is positioning. On the economy, 62% of fund managers now forecast stagflation. That is now the majority view. That changes from the expectation of boom expectations last month, where 65% of fund managers thought there was boom. 60% think we're late cycle. 51% think inflation is permanent. So it's now a majority of fund managers think this inflation is permanent. That's up from 39% last month. So that's the state of play in terms of current consensus view on the economy. In terms of sentiment, you're seeing rising cash levels, but cash levels are rising really at the expense of bonds. People really selling bonds a lot and aggressively. Equities are down a little bit, but not nearly as much as bonds. Hedge fund exposure to equities is the lowest since April 2020. In terms of positioning, you have fund managers that are heavily overweight cash, heavily overweight commodities, again, positioning for that inflationary environment, overweight healthcare, overweight energy, overweight staples, overweight the US. And they continue to be heavily underweight bonds. So that is the state of play in terms of fund managers and what they see in the economy and where they're positioned in markets. And again, I don't think, as Andrew said, I don't think it's terribly surprising. It could be more underweight equities, but in general, I think it's pretty much in line with what we would assume fund managers are seeing.
Yeah, it's interesting. I think the thing I was most intrigued by, Ben, you note that kind of the bull bear indicator came in at 2.8. So if you remember, we've shared screens on this before. It's kind of that scale up to 10, 10 being very optimistic, on the lower end, obviously being more bearish. So it came in at 2.8. It was 2.9 last month, and you noted that you were kind of surprised it didn't go down further. I don't know that I agree with your speculation that it would be lower. I mean, one of the things I keep looking at, and I kind of keep hammering, they're buyers in this market. And obviously we don't necessarily know who they are. I mean, this data would suggest there's really no telling, but I was looking at just raw price level of the S&P 500. We're down like 1.15% from where we were the day before Russia's invasion of Ukraine. So we've obviously had massive headlines, but we've also, I feel like we've seen relatively decent resiliency from the market, which suggests to me that there is some capitulation going on. There are people weighing whether they should be, putting their toe into the water and should be optimistic about the pricing. We mentioned lowest equity positioning since April of 2020. We kind of know what happened in the period immediately thereafter. Ben, what do you think I'm missing in terms of, I think, you and I were talking about this before the call. There is concern that, hey, there could still just be a real flush out. But for me, it seems like we continue to get headlines on a war that seems like it's going to last longer than many people expected, certainly at the very beginning of this invasion of Ukraine. But at the same time, the market's not just totally bleeding out here, which again just suggests to me that there are people coming in and taking advantage of opportunities. What are your thoughts, Ben?
I think that's right. I think that people are still trying to pick areas where they want to be. And actually, that's one of the reasons why I do wonder if we need more of a capitulation in the markets. Because right now, people are almost trying to continue to buy into these these opportunities. And I do think there are a lot of good opportunities out there. And I think that you'll look back at these levels in a year, 2 years, 3 years, and be really pleased at these levels. You're like, man, wish I was buying more stocks at that point. But in the short term, I think that the time frame for a lot of investors is contracting. So whereas in good times, people have a 10-year view and you say, well, you're on track for a 10-year plan. Nowadays, and when you see these dramatic market moves, that time frame compresses. So you become much more hypersensitive to short-term moves. And that it's not just retail investors, that's for professional investors too. Hedge fund is some of the fastest money and a lot of times not the smartest money out there. And you're seeing already start to capitulate, especially what we're seeing in fixed income, what we could end up seeing in equities, which is just this capitulation of why would I want to own stocks right now? And I think that we're starting to see some of that based on some of the conversations we've had in the last couple of days. But I don't think we've seen that en masse yet. So I think we're close to that, but I don't think we're quite there yet. But again, I think that these values that we're seeing today in the markets are reasonably attractive.
Thanks, man. Yeah, and it raises the question. I mean, we'll say this on this call. We've said this before. It might seem a little bit repetitive, but I would just remind people, for us, when we're looking at asset allocations and how we want to be positioned within a certain portfolio, this is very long-term in nature. Obviously, allocations can change as life circumstance changes, as cash needs change for a given client. We're individualizing all of these things so that we can be as responsive as possible to clients on the end. But one of the things we mentioned, Tom and I were in a meeting yesterday with a new client that's coming on board. And one of the things, we just kind of stress, it's like, look, the market's down, 12, 13%. Nobody likes that. We don't want to come off as we don't care or we're just high-fiving, yay, the market's down. That's certainly not the case. You can probably tell that even just by the tone of these calls. We would prefer the market to be up 12%, not down 12% at any given moment. But one of the things that we're really thinking about is really kind of the range of potential outcomes for each asset class. And so through that lens, I mean, one thing we just want to kind of consistently remind clients is that a 12% move is really something that we feel like within the portfolio management aspect of our relationship, we ought to be able to, for lack of a better term, kind of take in stride. We ought to be able to identify opportunities, stick to the allocation targets that we have identified in calmer times, and continue to execute. And in the past, when we've seen these corrections, whether it was in late 18, whether it was the much, much, much larger correction in February and March of 2020, that was the strategy. That's the strategy right now. And so we're continuing to look for those opportunities. On the equity side, we're really trying to manage portfolios for a more normalized environment. And that's what we're trying to do, really, even when we're establishing asset allocations. When we say, hey, we want this client to be 63% equity, it's because over the long term, we think 63% equity is the appropriate allocation. And in normal times, we think that's going to work. And in times of volatility, we think it's going to be appropriate and a level that we can withstand. So on the equity side, we're really trying to, as Ben mentioned, look at the level of where we're seeing companies trade. We're really focusing on high quality companies, everything from Apple and Microsoft to American Express, BlackRock, a lot of these companies that we really feel like we can be proud that we own and be proud that we purchase these at this level. And we're also at the same time really prioritizing stability. Tom, on the fixed income side, what are you looking at tactically in terms of decision making?
Well, there's a couple of things. I think one thing that's happening that's worth noting is the push out of bonds is probably net helping the stock market. Because if you think about performance year to date, bonds have obviously sold off, but they sold off about, let's call it 1/4 of the stock market. And so people are saying, these bonds, the writing's on the wall, interest rates are going up, they're not going to perform this year. So the selling there, I think, is actually helping the bond or the stock market. People are flowing that money back into stocks. And I think that's adding a little bit of support. In terms of where we're buying on the fixed income side, we're really able to buy anywhere we want right now at levels we haven't seen in quite some time because of the flatness of the yield curve. And so when it comes to each individual portfolio, we can basically say, we're going to look at, Joe client's account, and maybe over the last couple of years, we haven't been able to buy bonds in the 1 to 5 year range because of the way the yield curve was so steep. And so, we can add value by, basically filling in holes in bond ladders at pretty much any spot we need in any particular portfolio because of the way it's so flat. Because a 5-year bond is yielding the same as a 10-year bond is yielding the same as a 12-year bond. And so we can say, hey, last year we could really only buy bonds 7 years and out. And so now we have the opportunity to fill in that 7 years and in. And that goes for every portfolio. And obviously every fixed income portfolio is different. But, based on how the time has passed, you can kind of see where we were when we were buying the bonds initially, and we can fill in gaps from there. Additionally, we were very aggressive buying floating rate bonds towards the middle of last year when rates were ultra low, and they were very out of favor. And while they haven't performed excellently, what we are seeing now is most of those bonds are LIBOR linked, and LIBOR has essentially septupled in the last, call it 8 weeks. Basically went from 11 basis points all the way up to like 85 basis points. So if you have a coupon that's LIBOR plus a spread, you're suddenly getting about 70 more basis points per coupon, and most of those are paid on a monthly basis. And so as rates rise, you're getting paid more and more and more. And eventually the market's going to come around and say, hey, these bonds are actually super valuable now, and they're going to be in more demand, and we'll see some price increase there. Or potentially we'll get called out altogether, in which case we can reinvest, and that's going to lead to outperformance. But in the meantime, we'll just be satisfied with getting paid more every month. And, that's a big part of the portfolio. It's a big piece we added over the last couple of years. And I think we're really well positioned should rates rise, especially if we get a rate hike. LIBOR is going to tick up 25 basis points overnight. That's an instant add to the portfolios. Whether or not that pushes the prices up right away is really, a non-issue to us, because the income produced by those bonds is going to go up no matter what.
Awesome. Thanks, Tom. On the optimistic side, airlines talking relatively bullishly about what they're seeing in terms of their guidance. We've heard from Southwest. We've also heard from Delta. Tom, you're the resident airline expert. How much should we read into the positivity from the airlines?
I think we should definitely be keeping an eye on that, especially as COVID sort of unwinds. And obviously we're seeing some headlines out of China where they're starting to see a tick up in cases. But I think a lot of that is delivered through the zero COVID policy. They basically made it so, they had zero COVID for so long, so they don't have just the random people who were walking around who didn't know they had it like we did, and the herd immunity is essentially at zero. And so I think you're going to see in some of those countries big numbers, but I don't think that's going to affect the airlines as much as you think. Southwest basically said they've done a great job hedging fuel prices. They've done a great job at maintaining demand, that they're basically back to 70 to 85% load capacity. Delta came out and basically said the same thing, that they're back to about 80% of 2019 levels. And, they're seeing a lot of demand, particularly domestically. And we had a meeting with a potential client probably 2 weeks ago now, who was a Delta pilot who was getting ready to retire. And he was saying that there's just unbelievable demand. They can't find enough pilots, even for domestic travel, that while international travel is not what it used to be, he's flying all over the place, California, Seattle, back and forth, even if it's a one-day trip, because they just need people to cover these routes. And also they're talking about maybe increasing the retirement age from 65 to 67. There's an FAA requirement, and when my dad was flying, it was 60. You had to retire. They basically said anybody who's 60 years and older is too old to fly an airplane. But I think we all know that 60 is not what it used to be. And so they're looking at pushing that back to 67 because they're having trouble finding enough pilots. They're having trouble covering all the flights because there just is a shortage there. And a lot of guys took that early retirement payout as part of the COVID packages to, avoid furloughs. But now they're basically saying, hey, now demand is back and we don't have the pilots. And, it's not like it used to be where, when you flew in Vietnam, everybody could be a pilot. There are tons of planes. Being a pilot in the Air Force now is a very difficult task. There's not as many planes as there used to be. And so the number of pilots that naturally occur in the wild coming out of the armed services just doesn't exist anymore. And so they're really actively trying to get people into the system, into the regionals, to try and get that covered. And so I think there's going to be a lot of demand going forward. I think that, it maybe is a really good buying opportunity, particularly for something like Southwest, which is so domestically oriented versus a Delta or American Airlines, which is still struggling to get that international demand back up.
Awesome. Thanks, Tom. Ben, we got PPI data coming through. The expectation is that we would be looking at a 10% number on the year-over-year side, driven by a month-over-month increase of 0.9%, excuse me. Where'd we come in?
Yeah, we came in a little bit lower, actually, which is a pleasant surprise on the inflation data. So, yes, energy was really not good. And it meant that the headline number was right in line with expectations at 10% producer price index on a year-over-year basis. But if you exclude food and energy, you're actually talking about 8.4, which is only 1/10 higher than last month. And 3/10 less than the expectation. So I know it sounds crazy that we're arguing about 3/10 when you're talking about 8.4% inflation, and I get that. But the point is, on a rate of change basis, this is actually fairly positive because the rate of change is slowing in inflation on the core basis on the producer side. You could argue that that's bad because it might mean demand is starting to slow a little bit. But at the end of the day, we don't want the Fed to have to do a Paul Volcker and push us into recession because inflation is so high. So if inflation can level out and start to go down and moderate just a little bit, then that will allow the Fed to tap lighter on the brakes than they otherwise might. So it's positive news. The market's actually gone up on that. It was down earlier to start the day, but now it's up. And I think that's an appropriate move by the market. Whether or not that sticks is another question.
Excellent. Thanks, Ben. On the Russia side, continuing to see shelling of Kyiv, more death, more damage to residential buildings, more just kind of atrocities as we continue to watch that situation. Ukrainian officials say more than 2,500 civilians have died in Mariupol. Those that are still there are really, really lacking for necessities like electricity, water, heat. There's about 350,000 people there. Fourth round of talks between Russia and Ukraine were expected to continue, but they are on pause for the time being. Ben, we talked about this briefly before the call, but this thing's just going to drag out, it seems like.
Yeah, I think it's going to continue to drag out. The encouraging thing that we are seeing from the airlines is that demand continues to be strong from Americans, and so far this is not having a substantial impact on the economy. But we're going to have a big meeting on this later today as we evaluate a lot of the puts and takes. And I think we're definitely in a different wartime situation than maybe we've been in the past because of these economic sanctions and because of the way the world is so interconnected economically. So we're trying to untangle that web of linkages and decipher what's important and what's not.
Awesome. Tom, last thing, Puerto Rico. We've been talking about a bankruptcy settlement, restructuring some of their debt for half a decade now. Finally have a settlement. How's that shaping up?
Yeah, so basically what they're going to do is there are a number of bonds that were defaulting, really sort of on the back half of the financial crisis. And what they've done is they're basically going to pay out a portion of bondholders, and then they're going to give them a new set of bonds to replace that. And on top of that, they're going to have, a value contingent built into the new bonds. It basically says if they take in an excess of taxes, then they're going to get a little bit extra of a payout. And as well as they're going to settle off some bonds, they're basically going to get, pennies on the dollar for another portion of the Puerto Rican debt that they just can't be satisfied. And ultimately, that's why you buy bonds, is because even if things go really, really poorly, there's always a way, either through bankruptcy or payout, to get some money back. So even if you paid 50 cents on the dollar for a bond that was really, really struggling, in some of these situations, these people are going to get 35 cents back. Plus, they got paid some income along the way. So you're really never in a position for a total loss. Puerto Rico is just a classic example of, the economic theory of unintended consequences, which is that Puerto Rico bonds are triple tax exempt, which means if you own them, you don't pay state, local, or federal tax on the income generated on those bonds, which puts it in a bad position because that makes a lot of demand for bonds for a place that's not that big. And so, they basically can issue debt because they know they can sell it. But the problem is the people who live there still have to pay that. They have to pay the taxes to satisfy that debt. And there's just not a lot of people or economic output from Puerto Rico to cover that. And so the second derivative of that law of unintended consequences is that the people who do live there avoid paying taxes. I've got a really good friend who works down there. He's a bond trader. And he told me on multiple occasions that there were places like taking his kid to the dentist where you get a cut in how much it costs just by paying in cash, because even the dentist doesn't want to pay taxes on the income he's producing. And so you basically have overissuance of taxable instruments. Then you have too heavy of a tax burden for the population, and it just leads to ultimately a default, and that's what we've seen here. But they managed to rectify it. I think it's a positive situation. I think it helps Puerto Rico going forward because they probably do need to issue some new bonds. They've got a terrible problem with their electric infrastructure. As we've seen many times when they get hit by a hurricane, everybody loses power for weeks and it becomes a humanitarian disaster. So I think it's positive for everybody. I think the bondholders are going to be satisfied for the most part. And I think that going forward, Puerto Rico is going to be in a better spot in terms of issuing new debt.
Awesome. Thanks, Tom. Thanks, Ben. We're going to wrap it up there. We'll be back tomorrow morning at 8:30. Hope you guys have a great day, and we'll talk to you soon.